Welcome, everybody. This hearing of the Small Business Subcommittee on Economic Growth, Tax, and Capital Access hearing is called to order. I would like to thank the witnesses for appearing today to discuss one of the most important issues facing small businesses and, for that matter, our economy, the looming expiration of the 2001-2003 tax rates. Despite a feeble economic recovery at home, economic turbulence abroad, and a series of political and policy actions in Washington that have left small businesses as uncertain as ever, many of our nation's small firms have learned to survive and adapt to whatever the marketplace or Washington has thrown at them. Understanding the challenges they face and how we in Congress can foster an environment where they can succeed is a constant focus of this committee. Most businesses in the United States are small, and unlike many of their large counterparts that are subject to corporate income taxes, the vast majority of small businesses are organized as pass-through entities where the taxes are paid by their owners at individual rates. Acknowledging and understanding this distinction is important. While there is broad agreement that allowing all of the tax relief enacted in 2001 and 2003 to expire is inappropriate and should be avoided, there is wide disagreement on the composition of an extension and what it means for small businesses. The Obama administration and some of my colleagues on the other side proposed that taxes should revert to higher rates for taxpayers earning more than $200,000 a year. They claim that this proposal would only raise taxes on 3% of small businesses, but that 3% figure accounts for more than 900,000 small businesses. Most of my Republican colleagues and I support an across-the-board extension of current lower tax rates. We believe that imposing the higher marginal rates on earners making more than $200,000 a year would most directly affect those small firms responsible for generating the majority of small business income and new jobs. We would also note that in addition to higher marginal rates on these businesses, the administration's proposal could also result in small pass-through businesses being taxed at rates higher than some of our nation's largest multi-billion corporations. That's not my definition of tax fairness. Finally, in addition to the prospect of higher marginal income tax rates, small businesses must also contend with uncertainty created by the expiration of the estate tax and how this unresolved policy issue affects long-term business planning. The purpose of today's hearing is to examine these issues in more detail and to understand how policy actions in Washington are continuing to create uncertainty for small businesses. Before I yield to Ranking Member Schrader for his opening statement, I ask for unanimous consent to insert into the record these statements small businesses have submitted to the committee's open mic web forum regarding their concerns about higher taxes and tax uncertainty. Without objection so ordered, I now happily yield to Ranking Member Schrader for his opening statement.
Thank you, Mr. Chairman. I appreciate the committee's indulgence and apologize to the panel and others for being here late. Had some constituents come in unexpectedly, and they came a long way. I'm from Oregon, so one does what one has to do. The economy has been gaining strength, largely because of the powerful role played by small businesses in America's economy. It's been a tough haul the last few years. It's been a very tough haul. It's been our history that small firms have been the biggest job creators in America. Bolstering the economy in the tough times and bringing us out of the depths of these recessions. This has been a tough one. This has been a very tough one. When it comes to providing assistance and assuring small firms that they have the tools they really need, one thing's been clear: the Internal Revenue Code has provided a lot of obstacles to each and every one of us. As I've said in previous hearings, as a small businessman myself, there was a time when I did my own taxes for my business. That is long since gone away, long since gone away. A lot of small firms depend on certain tax incentives to offset the costs of innovation and expansion, And I have supported those temporary tax revisions and extenders because it's important to give small businessmen and women every tool in the toolbox in these tough and difficult times. The expiration of many of these tax provisions is fast approaching, this so-called fiscal cliff that we all hear about. And small business owners have some very tough, difficult choices to make and don't know which way to turn, given the uncertainty that's been created out there. Your input here today will be vital, I believe, in helping the Chairman, myself, and the rest of the members of Congress decide which of the extenders are of great value, which are of some value, and which are of less value. As many of you know, we have our own budget to deal with. We seem to have a great deal of trouble passing budgets these days, which is a shame because you have to do that every year and plan in advance. We have a long way to go to catch up with a lot of you all. And right now, in my humble opinion, this is myself talking, there's a lot of rhetoric on both sides about taxing this group or not taxing that group or taxing people of below certain income levels. I come from Oregon. $250,000, you're pretty darn well off if you got $250,000. So this rhetoric about millionaires tax and $250,000, I think it misses the mark. And what many of us are looking for in the real world is comprehensive tax reform. And as the Chairman indicated, not just for corporate America, not just for C Corps. Most of American businesses, most of American small businesses are S Corps or LLCs or partnerships or sole proprietors. And this is a group that we want to make sure gains through tax reform. A lot of proposals out there for it. It means different things to different people. Everyone sees it through their own eyes, if you will. But there are some very exciting proposals about just getting back to basics, eliminating maybe all tax breaks and reducing tax rates. And so today I hope we have an opportunity to chat about which of the extenders are most important, should we decide to continue with that policy, and what effect eliminating all tax breaks would have on small businesses if we're able to buy down your tax rates dramatically like been proposed in several different bipartisan proposals out there. So I look forward to hearing from the committee, Mr. Chairman, and appreciate you having this hearing.
Thank you, Congressman Schrader. If subcommittee members have an opening statement prepared, I ask that they be submitted for the record. Each witness will have 5 minutes to deliver your testimony. Try your best to adhere to that limit. We will begin with Theresa Kern, our first witness. She's the owner of M.A. Steel Erectors, Inc., a construction company located in the greater Chicago of my home state, Illinois. M.A. Steel Erectors has been in business for more than 30 years and is organized as a Subchapter S business. Ms. Kern will be testifying today on behalf of the Women Construction Owners and Executives, where she recently served as that organization's president. Ms. Kern, thank you for appearing today. I look forward to your testimony.
Good morning, Mr. Chairman, members of the subcommittee. My name is Theresa Kern, and I'm the owner and president of M.A. Steel Erectors, headquartered in Palos Heights, Illinois. We are a union signatory specialty trade subcontractor that provides labor to install reinforcing steel in commercial, industrial, heavy, and high-rise construction projects. M.A. Steel is incorporated as a Subchapter S pass-through corporate entity, and I am the sole shareholder. I am testifying today as both a small business owner and in my capacity as immediate past president of Women Construction Owners and Executives, a 30-year-old national organization whose mission is to simply create contracting opportunities for our members, women who have chosen to build a career and a business in the non-traditional construction industry. Thank you for giving me the opportunity to testify before you today at this very important hearing. As you know, the lingering economic recession has significantly damaged the construction industry, and most small business in our industry have been hit disproportionately hard. Yet WCOE members are optimistic about the future as the construction industry economy begins a slow recovery. The future tax policy of the United States will have a profound effect on our members' ability to stabilize and then grow their businesses. M.A. Steel is a labor-intensive business, as are most construction companies, and business growth has a direct correlation to creating badly needed jobs to help the American economy grow and prosper. While media headlines blare, corporations don't pay their fair share, Let me assure you that small business corporations not only pay their fair share, but are a major contributor to the economy as well as the tax base of this country, and have often been referred to as the lifeblood of the U.S. economic growth engine. Ernst & Young is reporting that 90% of all U.S. businesses are corporate pass-through entities and employ more than 50% of the private sector workforce, while representing over a third of all U.S. business receipts. Pass-through entities are sub-S corporations, S-corps, and limited liability corporations, LLCs, that have specific limits as to the number and type of shareholders. IRS reports that there are over 4.5 million subchapter S corporations alone. It is often said that small businesses are the cornerstone of the American economy, and corporate pass-through entities are the cornerstone of America's small business community. Generally, entrepreneurs are advised by their CPA or attorney to incorporate using one of these congressionally chartered tools in order to separate her business from her household assets without the onerous paperwork and reporting requirements of a C Corp. Congress also decided in 1958 that these special, privately held corporate entities would not be taxed as a corporation, but rather because the owner-entrepreneur was investing her own money into the enterprise to get it started and often to keep it running, the income or loss generated by the sub-S or LLC Corp would be reported by the owner on their individual tax returns as earned income or loss. The pass-through corporation, whether a sub-S or LLC, is therefore not liable for income tax, but the shareholder is. The business's entire profit or loss is passed through to the individuals who report it on their household tax return at the rate for their total household tax bracket. Conversely, profit distributions to C Corp owners are treated as dividend income to the shareholders and currently taxed at up to 15%. When the media trumpets headlines like 90% of corporations pay no taxes, they may be statistically correct, but these are not corporations as the general public defines corporations. These are mostly small business owners who have been advised to protect their household assets by incorporating and to use an LLC or sub-S corporate structure to eliminate the requirement for big corporate boards of directors, annual meetings, elections, expensive audits, and activist shareholders. With the 2002 passage of Sarbanes-Oxley, which mandated even more rigorous reporting requirements for C Corps, pass-through entities are even more attractive. What is critically important to understand is that profits in a business incorporated as a sub-S or LLC entity does not translate to cash in the pocket of the owner. But a loss in a business nearly always requires the owner to either forego her own salary or even invest more of her own money into the firm. There is one other thing that all corporate pass-through entity owners know. While the company may show a profit in the financial statements, there may be no cash in her corporate or personal bank account. Further, there is no relationship between the amount of profit a sub-S or LLC entity shows on a financial statement and the amount of money an owner has actually withdrawn. Please let me also explain one of the anomalies about the construction industry. Unique to construction is the issuance of a surety bond, which is a guarantee of performance on a project that an owner of a construction company must collateralize with the business's balance sheet and personal assets. Nearly all construction projects require a surety bond performance guarantee from all of the contractors and subcontractors working on a project. Because construction company balance sheets have taken a severe hit during the past 4 years, banks and bonding companies are insisting that balance sheets be strengthened by keeping profits in the company. It is important to note here that the surety bond on a specific project cannot be released until the final retention is released at completion and acceptance by the owner. My ability to begin a new project is restricted by my balance sheet, which remains encumbered until those assets are released when the bonded work is accepted and final payment received, a process that often takes many, many months after project completion. If I want to take on another project prior to the release of the retention of money in order to keep my crews busy, I need to have sufficient assets available to secure another bond. Let's assume I'm lucky enough for MA Steel to make a nice profit this year. My bank and bonding company will require that I not only pay myself a minimal amount, but that I leave the profits in the business in order to show a stronger financial position. As a sub-S Corp, however, all of that nice profit will be reported as income to me, and I will have to pay tax on it, even though I may not have 1 penny of it in my personal checking account. When we are talking about an average contract value of $500,000 and dozens of projects a year, it is not unrealistic to expect annual business profits to exceed $250,000, all of which is reported as retained earnings in the business and is income to me. Yet the majority of that profit stays in the business and never makes it to my personal checking account for my own use. I am liable for payment of the income taxes due on this phantom income at the individual tax rate. Increasing the rate of this tax by even 10% will have a significant deleterious effect on my ability to grow my business. I have to keep the profits in the business per demands of the bank and bonding company if I want to grow, yet I have to take the profits out of the business to be able to pay the taxes. The members of WCOE fully support simplification of the tax code and closing tax loopholes that are beneficial only to the most sophisticated financial analysts. We also support efforts to decrease the federal budget deficit, but to do it on the backs of America's robust entrepreneurial community will be counterproductive. I would like to give you one more relevant example of what the current uncertainty with the tax code means to small business owners like me.
Thank you. I need to stop you right there. You're doing great. I need to stop you right there. Your entire testimony will be part of the record.
Okay.
But we need to move on to the other witnesses. But thank you
Okay.
very, very much.
All right.
That was
Thank you.
wonderful. Let's move to Doug Harmon, our next witness. He is CEO of Twin City Die Castings Company, a second-generation family-owned business located in Minneapolis, Minnesota. Twin City Die Castings is a subchapter S business employing about 250 full-time workers. He's testifying today on behalf of the North American Die Casting Association, where he serves as a member of that organization's Government Affairs Committee and Board of Governors. Mr. Harmon, thank you for appearing today. We look forward to your testimony.
Good morning, Chairman Walsh, Ranking Member Schrader, and members of the committee. Thank you for the opportunity to testify today. I'm here to discuss the severe economic consequences that small manufacturers will face due to the so-called fiscal cliff as it relates to taxes that will occur in January 2013 unless Congress intervenes. Failure to act on the looming year-end tax increases would yield the largest tax increases in American history. My name is Doug Harmon. I am the CEO and owner of Twin City Die Castings Company, a second-generation family-owned business employing 250 employees. We manufacture hundreds of different types of precision aluminum and magnesium die castings for the automotive, recreational, industrial equipment, defense, aerospace, computer, and medical industries. I am testifying today on behalf of the North American Die Casting Association, where I serve as a member of the Government Affairs Committee and on the board. NADCA is the sole trade and technical association representing over 300 U.S.-based companies and industry suppliers that produce and sell castings essential to the manufacturing process. Twin City Die Castings is one of the oldest die casting companies in North America. It was founded in 1919. My father took a gamble and purchased this small business in 1974 with the family savings. After college, my brothers and I joined the business. My dad taught us not only how to produce quality castings, but the need to invest in our employees in the shop. On the table in front of me are just a few examples of the wide variety of castings we have produced. This happens to be a military application, a hospital application, and an automotive application. We operate 3 die casting facilities in the U.S., and we are exporting 22% of our total castings in 8 different countries around the world. In all our operations, we provide good-paying blue-collar jobs, health reimbursement accounts, and other benefits to our employees, whom we consider as members of our extended family. The recession hit our industry and my company hard. A number of die casters that had been in business for more than 25 years were forced to shut their doors. We were faced with downsizing our workforce from 150 we were faced with downsizing our workforce to 155 workers from 250 when millions of dollars of orders simply dried up. Fortunately, orders have been slowly coming back and we're able to rehire many of our employees, but we are still not back to pre-recession production and sales levels. In 2012, we have been much more cautious in our hiring and the types of capital improvements that we have undertaken given the uncertainty of our taxes and the fragile economy. For manufacturers like me, this tax cliff is a serious threat. Not knowing whether or not Congress will renew the Bush-era tax cuts and the pro-business tax extenders, which expired at the end of 2011, is keeping many die casters, and for that matter, most manufacturers from investing as much as they could to grow their business, purchase new equipment, and hire more employees. In order for die casters to prosper in this country, we need two things: stability with a pro-growth approach and transparency in our tax code. How die casters are organized and the way we pay taxes has the single greatest impact on our industry. Our company is structured as a subchapter S corporation where the individual owners pay the taxes. More than 70% of manufacturers are structured as S corporations or other flow-through entities, meaning they pay taxes at the individual rate. Since we are put in the top tax bracket, we could see our rates jump to 39.6% from 35%. We could also face a 3.8% tax on certain types of investment income passed in the Affordable Care Act effective in 2013. On top of these increases, small businesses like mine will also have to deal with a 0.9% surtax on wage income earned above $200,000 for individuals and $250,000 for couples. Bottom line for Twin City Die Castings Company is that if the current tax rates are not renewed by January 1, 2013, and individual rates increase by nearly 5%, we will face a hefty increase in our tax bill. We will not be able to reinstate the 401k match for our employees' retirement, nor will we have the extra funds to increase our workers' health reimbursement accounts. Unlike larger corporations, small manufacturers like us are required to provide a personal guarantee for most loans when purchasing capital equipment or expanding our facilities. This means as a small business owner, I put my family's home on the line and take significant risks if I want to grow the business and compete in the global economy. This is where tax deductions and credits come in as the only tool we have to reduce our effective tax rate unless Washington can finally act on a comprehensive tax reform. Several key business tax breaks currently available are set to change or expire entirely after December 31, 2011. In particular, we urge lawmakers to renew tax extenders widely used by manufacturing companies, such as the R&D credit, bonus depreciation, and Section 179 expensing. These historic capital investment incentives have had a positive impact and incentivized manufacturing, purchasing, and job creation in recent years. In conclusion, small manufacturers cannot compete globally or even survive domestically if we do not continually invest in equipment and our people. This is why tax reform is so important to manufacturing companies across the country, to free up capital for investing in people and equipment, to provide more certainty so we can plan for future years. We cannot afford to fix our nation's problems on the backs of small businesses and their employees. Thank you for the opportunity to testify before the committee today, and I look forward to answering your questions.
Thank you, Mr. Harmon. I now would like to introduce Scott Hodge, President of the Tax Foundation, a nonpartisan tax research group based right here in Washington, D.C. Mr. Hodge, welcome. I look forward to your testimony.
Well, thank you, Mr. Chairman, Mr. Schrader, and members of the committee. I appreciate the opportunity to talk about this really important issue. And as we've heard, American entrepreneurs are facing a lot of uncertainty right now, not only the stalled economy, but obviously the fiscal cliff that we're facing at the end of the year. And unfortunately, there's many in Washington who say, well, we shouldn't worry about the economic impact of allowing these top tax rates to expire because only 2% of pass-through businesses will be impacted. And I think this view is badly mistaken. I think it's like saying that, well, we shouldn't worry about the economic impact of cancer because NIH tells us that only 0.5% of Americans will be diagnosed with cancer this year. Well, as you know, we spend tens of billions of dollars each year on cancer research, testing, and treatment because we understand that how much it costs the economy each year in lost productivity, not to mention about 500,000 of us that are expected to die of cancer this year. And it's the same with the impact of higher taxes on business. The issue is not how few businesses will be impacted. The relevant economic question is how much business income will be hit with higher taxes. And no matter how you parse the data, the evidence is very clear that the vast majority of pass-through business income is earned by high-income taxpayers, and they would be disproportionately harmed by such a tax increase. In fact, Tax Foundation research has determined that nearly 40% of any new revenue raised by boosting these top tax rates would come from the most successful businesses. And based on the most recent revenue estimates, we expect this could amount to a tax increase of $377 billion over the next 10 years on these pass-through businesses. And by all accounts, that would amount to a success tax on our best and brightest entrepreneurs, and probably the largest tax increase on small business in American history. And to understand the impact of this, we need to understand some basic facts. First, there are more than 30 million pass-through businesses today compared to less than 2 million traditional corporations. And there's now more business income that's taxed under the individual tax code than under the traditional C code. And Treasury estimates that as much as 40% of all business taxes are now paid on individual tax forms. And high-income individuals earn the vast majority of this business income. The Joint Committee on Taxation now estimates that if the Bush-era tax rates were to expire, 53% of net business income will be reported on returns that will have a marginal tax rate of either 36% or 39.6%. IRS data shows that 72% of all pass-through income is earned by taxpayers earning over $200,000 a year. And 36% of all that pass-through income is earned by people with $1 million or more on their tax returns. The economic evidence is very clear, and it suggests that increasing top marginal income tax rates on individuals would be very detrimental to America's long-term economic growth. Economists at the OECD have determined that high personal income taxes are second only to corporate income taxes in their harmful effects on long-term economic growth. And it's well known that the U.S. has the highest corporate tax rate in the world today, but I bet few of you realize that America has the most progressive personal income tax system in the industrialized world. And what that means is that the top 10% of taxpayers pays a larger share of the income tax burden than their counterparts in high-tax countries such as France and Sweden. And the economic research is quite clear that there is a big trade-off between tax policies that enhance growth and tax policies that are aimed at equity, meaning the more we try to make the income tax system more progressive, the more we undermine the factors that lead to economic growth, such as investment, risk-taking, entrepreneurship, and productivity. Our economists estimate that cutting the top personal income tax rate by 10 percentage points could lead to an increase in total GDP growth of 7.5 percentage points over a 10-year period of time. We would see even greater economic growth by cutting the corporate rate by 10 percentage points. Well, let me conclude, Mr. Chairman, by saying, they say when you tax something, you get less of it. So why would we want fewer small businesses, lower wages, and less economic growth? Because those are the consequences of allowing the top tax rates to expire on January 1st. But by reforming the tax code and cutting tax rates on businesses, we would see higher economic growth, higher wages, and better living standards for all Americans. And that should be priority number one for all public policies. Thank you very much, Mr. Chairman.
Thank you, Mr. Hodge. I now yield to Ranking Member Schrader so that he may introduce our next witness.
Thank you very much, Mr. Chairman. It's my pleasure to introduce Jeffrey Porter, founder and owner of Porter & Associates in Huntington, West Virginia. His firm concentrates on providing tax planning and business advisory for small and small businesses with high net worth individuals. Mr. Porter has been active in the American Institute of Certified Public Accountants, a group we should probably take advice from more often, for over 20 years and currently serves as the Vice Chair of the Tax Division Tax Executive Committee. Welcome, Mr. Porter.
Thank you. Good morning, Chairman Walsh, Ranking Member Schrader, and members of the subcommittee. I am Jeffrey Porter, Vice Chair of the American Institute of CPAs Tax Executive Committee and a sole practitioner at Porter & Associates in Huntington, West Virginia. I consider myself a small business, and I provide tax planning and business advisory services for small to medium-sized businesses and their owners. On behalf of the ASCPA, I am pleased to have the opportunity to testify today on the topic of the small business perspectives on the tax cliff. This year has been an extraordinary year for uncertainty in taxes as well as the macroeconomy, making it difficult for small businesses and their owners to make informed business and financial decisions. Unfortunately, this uncertainty is not limited to one or two provisions, but instead affects many areas of the Internal Revenue Code. The uncertainty becomes even more unsettling when you look at the potential changes in tax treatment for some of these items. For example, qualified dividends are currently taxed at a maximum rate of 15%. However, beginning next year, the same dividends might be subject to an income tax rate of 39.6%. Multi-year planning and the ability to predict, or at least to estimate, business profits and taxes are critical in operating a business. It is also essential to know the future income tax rates in structuring major business transactions, such as in the sale of a business or of its assets. In order to determine a sales price acceptable to both the buyer and seller, both parties need to understand their potential tax liability for the current year as well as any future year. Without this information, it is extremely difficult for either party to make an informed decision. Tax considerations are even more substantial if the sale is structured as an installment sale and the seller will report income or capital gains over a number of years. This situation happens frequently since banks are hesitant to lend money in many types of these transactions. And next, I would like to discuss the tax extenders, which in the last several years have repeatedly created uncertainty and confusion. The on-again, off-again nature of extenders, coupled with retroactive tax law changes, make long-term planning difficult. They result in the filing of amended returns and significantly increase the overall complexity. Two of the most significant tax incentives for businesses to invest in machinery and equipment, the Section 179 election and bonus depreciation, are both part of these extenders. These areas have a substantial impact on businesses, as the ability to write off a substantial capital expenditure at one time may determine whether a business owner purchases an asset this year, next year, or perhaps not at all. Although income taxes are not the only factor in making most business decisions, prudent business owners want to understand the tax consequences of a transaction. We also urge you to address the AMT rules. The AMT tax rates and exemption levels are not indexed for inflation, and as a result, the AMT exemption has become an annual problem. For example, there is currently no AMT patch for 2012. As a result, estimated tax planning for small businesses has to take into account the lower AMT exemption amount. This means that many small businesses will essentially provide the government with an interest-free loan or risk paying an underpayment penalty if the AMT patch is not passed retroactively. It is a no-win situation for these taxpayers. It is important for Congress to reach an agreement with regards to the expiring tax provisions as soon as possible. The uncertainty of the tax law unnecessarily impedes long-term planning for businesses and prevents owners from making informed decisions. I also strongly urge you not to underestimate the effect the tax cliff has on tax administration. If Congress waits until late in the year or even into next year to enact tax law changes, the IRS and commercial software vendors must scramble to revise tax forms and update software. As we experienced just a couple of years ago, this process would likely delay the initial date when many taxpayers, including small business owners, can file their income tax returns. As a result, affected taxpayers would receive their refund checks later than usual, which is particularly concerning for businesses operating under a tight cash flow. Last-minute changes are also very problematic for CPAs. Our members, a vast majority of whom are small businesses themselves, would face an increasingly compressed and perhaps hectic busy season. They would need to educate clients on the changes in the rules, advise owners on the tax consequences of business transactions, assist small businesses and individuals with tax and cash flow planning, and prepare income tax returns, all in a relatively short period of time. Thank you again for the opportunity to testify, and we'd be pleased to answer any questions you may have.
Thank you, Mr. Porter. Thank you to all the witnesses. I just have one quick question because I want to hear from my colleagues, Congressman Schrader and everyone else. Mr. Hodge, the Joint Tax Committee estimates that the administration's proposal for higher marginal rates will apply to more than 50% of small business income. You focused on income in your testimony as opposed to the aggregate number of small businesses affected. Why is that emphasis more important, focusing on income as to the number of small businesses that might be affected?
Mr. Chairman, it really has to do with the economic power or success of these businesses as opposed to just their sheer number. As you mentioned in your opening remarks, these are over 900,000 small businesses, but these are really the most successful, dynamic, and hopefully growing businesses, and thus they will bear the disproportionate share of any tax increase.
One quick follow-up on another topic. I suppose then that wouldn't be by definition a follow-up. So a quick question on another topic. Undoubtedly, when I'm home talking to small business owners, every single day the estate tax comes up.
Oh, yes.
Again, hitting us at the end of the year. How does this tax inhibit small business decision-making?
Well, there's the uncertainty that Mr. Porter talked about, and I don't know any small business person today who can plan around what's going to happen with the estate tax. But there's an awful lot of money spent, I think, needlessly on preparing for the estate tax. And there are some economic estimates that say the compliance costs and economic burden of the estate tax actually exceeds the amount of revenue that it generates for the Federal Government. The real people getting rich here today off the estate tax, maybe to a small degree the Federal Treasury, but are really the insurance agent or insurance companies, Mr. Porter and his colleagues, that are helping people try to minimize their estate tax burden, plan for it, and avoid having their company sold or undermined as a result of those higher taxes.
Quickly, in terms of promoting economic growth, what's the appropriate estate tax exemption rate? Is there one?
There should be no estate tax. The estate tax is double, triple taxation, in some cases even more. It is really an abomination. And unfortunately, it's sold as a way of controlling long-term wealth or the concentration of wealth. It really does not have that impact. In many respects, for many small businesses, it's an accidental tax because they weren't thinking about it. And all of a sudden, the owner passes away, the family now is left to sell the business, and to me, that's a crushing effect on the economy.
Thank you. Thank you, Mr.
Thank you, Mr. Chairman. Good testimony, and worried about our small businessmen and women, how we get out of this at the end of the day. And a lot of different competing proposals. As I alluded to in my opening remarks, unfortunately, we have to balance our budget, too. So while we'd love to be Santa Claus to everybody, we have to make some very tough decisions. Hopefully, we'll get around to making some tough decisions one of the days in this Congress. But it's important for us to have information, and that's why I have you guys here. A couple quick things. Don't care who takes this particular, but I was interested in explaining for folks, I think the panel has some pretty good understanding, but yeah, you know, the profit. Everyone says $250,000. I said it in my remarks is a lot of money for an individual. But when you're a heavily capitalized business, a lot of that can be taken up, and you don't ever see that income on your balance sheet. There's two or three things that come to my mind, but it'd be more powerful hearing from you. You know, in a business, making big investments either in equipment or in personnel, how does that show up on your income tax statement, and how might it affect how much you actually take home at the end of the day? Press your button, Ms. Kern.
Thanks, Ms. Kern.
The $250,000 that may show up on your financial statement reverts to your personal tax return. But the problem is it never leaves the business because your bank, your bonding company, they require those assets to remain in the business so that the business is qualified to have to be extended a line of credit or purchase equipment. You know, it's collateral. So that you, in some cases, don't even see that $250,000.
Exactly.
It just sits in your business and has to stay there. Depends on what your bank requires of you to extend their line of credit to you if you need
And your
one.
principal payments, how do
The principal payments on what? On your
I'd say your big piece of machinery,
Oh,
big piece of
absolutely.
equipment. That
Right.
You don't take home that either, and yet
No.
that would appear potentially on your tax statement
No,
as
right.
money that you'd have.
Right.
No, we're a very capital-intensive business, the die casting industry as a whole, and I know if you go back and looking at our investments in our business, we've averaged close to $3 million a year in investments, new equipment, new CNC machines, different technologies. I mean, it is, we're in a global economy. We have to compete with the Chinese, and to do that, we have to be more productive. We have to hire young kids that have technical abilities in programming these machine cells, where we have a machine and a robot and trim press, things like that. But it's just a heavy investment. So the $250,000, I mean, we're over $40 million in sales, between $40 and $50 million in sales, and $250,000 of profit is nothing. It's less than a percentage point of profit. And we need those funds to invest in equipment, but even more so, it's the people. I mean, we have a lot of training needs that we have, technology, seminars, things like that. We need to invest in our equipment. And quite honestly, since the recession, we've had to cut back on benefits. I mean, in 2009, we had to pull benefits back, cut hours, cut salary people's wages. We're now just starting to get back to where we can get some of those back in place. And now all of a sudden to have a 15%, I mean, from 35 to 39.5, besides some of the other taxes that come into play, I mean, it could be a 15, 20% increase in our tax burden. So it's just critical for manufacturing companies that are capital intensive to have that money available. The other thing is covenants with the bank. I mean, we owe millions of dollars to the bank because we've had to borrow over years to build our company up. And so there's covenants on what an executive can get, what I can get for a pay increase, what I can pull out of the company and a dividend. So I'm under the control of the banks that we borrow money with. So it's just important to have those funds available again for the training and giving our employees benefits back, and also for the equipment expansion. And these are good paying jobs. I mean, these are good blue collar paying jobs. I had our IT guy run an analysis of last year what our average wage was, and it was over $50,000. So these are good middle-class jobs that are being impacted here.
Mr. Porter, real quick on, I mean, as an accountant, you must be pulling your hair out the fact that we don't have anything closely resembling certainty in terms of what to advise your clients to do at the end of the tax season here. And you lived through this nightmare 2 years ago.
Absolutely.
And curious if it's different this time and how you try and advise people. And frankly, it's pretty obvious, I think, to everybody, at least here in Washington, D.C., we're going to do absolutely nothing till after the election. And then, frankly, it depends a lot on who wins the presidency as to whether or not we do anything in the lame duck session. What impact is that going to have on our economy and small businessmen and women?
Well, we did live through it 2 years ago, and I think it's probably a little more severe this time, just again because we've got the whole election cycle that we're into, and it makes it a little harder to even handicap what we think is going to happen. Many times you're telling your clients you don't know. You'll try to sit down and you'll say, well, we think if this happens, then this may happen, and if we think this happens, then this may happen, and that certainly doesn't bring any consistency or continuity for the clients to make business decisions about what they're wanting to do and invest monies.
And I guess one of the concerns I have would be that while we sit here in Washington assuming, well, geez, the deadline isn't until, taxes aren't, we got time, it's not January 1st, the April 15th. But maybe some of you could talk about the timeline that businesses have to have, but to make decisions. There's a certain lead time you need between your decision. You have to assume certain things if you're going to make investments in this economy. Particularly if you're a tool and die manufacturer, you're going to depreciate off this equipment. Do you buy it now, assuming the tax breaks go away? If they continue, what do you do? I think it's there's a timeline I think the businesses have to make decisions by that we don't take into account here in Washington, D.C.
I mentioned in my written testimony that I have a client that is wanting to buy a $2 million press, but I can't tell him what the depreciation schedules are going to be for that, because if he orders it today, it's 6 or 8 months before he actually gets that press and can place it into service. How can he decide if he wants to buy that if he's not going to be able to determine the after-tax cost? At this point, we can't tell him any certainty with what that is.
Hodge?
Yeah, I would also say that probably one of the reasons the economy is as slow as it is because the temporary nature of some of the fixes that we tried to enact, expensing and bonus depreciation are key to that. Had that been a permanent law, then you could have had businesses make those long-term decisions, which they can't now. And so I think that the benefits, the economic benefits of expensing were completely undermined by its temporary nature. If Mr. Harmon wants to build a new factory, that's probably a multi-year process. And so he can't make that decision if expensing is only in effect for 2 years. And so it's really, I think, important for lawmakers to understand that these provisions need to be made permanent. The R&D credit is another one in which, as you, I'm sure, have heard from many constituents, is really ineffective because it is simply on this temporary schedule. Half the tax code now is on a sort of a month-to-month or year-to-year lease, and that's no way to run a tax system.
So last question, I'd like just a quick answer from each of you because I'm probably over my time, but there's been a lot of discussion about tax reform. This is one of the few times, probably in my lifetime, where we actually have a confluence of horrific events and budgetary needs here in Washington, D.C., as well as at home, that comprehensive tax reform has some buzz. And we've had a lot of big corporations come in, probably mostly C-Corps, come in and talk to us about they'd be willing to give up all of their tax breaks, all of their tax extenders, R&D, bonus depreciation, oil depletion allowances, you name it, in exchange for significant rate reduction. Mr. Hodge, you testified in that 8 to 10% rate reduction. We are the highest. We have the highest tax rates in the world as of this past summer and stuff. Would it be advantageous? We'll go down this way because I want to hear Mr. Porter's summing up, given his background. But would it be advantageous, do you think, for America and maybe for your business, maybe you think beyond your own personal business, to get rid of almost all these tax breaks, maybe a cadre of some, but almost all, which means you'd have to give up yours. Let's assume that in this discussion, and in order to get a significant rate reduction, from 36 down to somewhere between 26 and 28, but down from 24 to about 15. And if you're really low income, hopefully you're making a little more than that. Although in this economy, who knows? From 15 down to about 10%. Ms. Kern, would you lead off with that?
I think everybody in this country is willing to do their fair share. And I also do feel that if we had some sort of a reduced tax rate that was commensurate with where we're kind of at or could be at now, I would be willing to do that if, in fact, those tax loopholes were or deductions were stopped for everybody. If it was a unilateral tax cut reducing people's deductions or whatever, and if it was a good tax rate that you could decide upon, I would be willing to do that, and I'm willing to pay my fair share if I make money.
Yep. Bottom line.
Okay. It would be nice if there was if the high tax rates that American manufacturers pay would be reduced a little bit. I'd be willing to just keep the tax rate neutral. Why I'm here today is I just don't want to see these tax rates go up because, again, in a capital-intensive business, you need that money to reinvest. So that's my concern is that all of a sudden, these rates go up, and so I don't know how the calculations would be as far as getting it tax neutral or maybe reducing it a bit, but it's the increase that is my concern.
Sure.
We cannot separate corporate and individual tax reform, unfortunately, because if we broaden the corporate base, we're going to be hitting the S-Corps and the LLCs just as hard. And really, there is only about $100 billion, I say only $100 billion, worth of tax expenditures in the corporate code, and those are shared between the C-Corps and the S-Corps. Right. And so we have to be very careful. And not every loophole is should be eliminated. Expensing, for instance, is not I would not consider a loophole. And we have to be very, very careful about having differential rates. This is the first time in the history of the tax code that the top corporate rate and the top individual rate are exactly the same at 35%. And we ought to keep that parity so we don't have arbitraging between the business forms. There are already various reasons, double taxation and so forth, to do so, but I don't think the rate should be part of that. And I think we ought to keep that parity. There's a lot of provisions that ought to be eliminated from the code, but let's not throw out also the baby with the bathwater, such as expensing the R&D credit and so forth.
Mr. Porter.
I can tell you that many of my clients regularly tell me they would like tax reform, and they regularly suggest percentages that they think would be appropriate.
Sure.
Many times I'm not sure they know what they're saying when they say that. But as the AICPA, we're on record as supporting Congress and encouraging Congress to do fundamental tax reform. We believe that we need good, clear tax policy. We need consistency so that business can plan. But we have not stated a desire or a particular position for any rate. But we do encourage Congress, and we have some principles that we think you ought to consider, called the Principles of Good Tax Policy. And it goes out and lays out what we think are fundamentals in terms of similarly situated taxpayers being treated the same. So you can't, game the system a lot. But there's a lot of those, and we encourage you to take a look at those, and we'd be happy to assist in tax reform in any way that we could.
Thank you very much, and thank you, Mr. Chairman.
Thank you. Maybe we all agree to something permanent. How about permanency? Congressman Chabot from Ohio.
Thank you, Mr. Chairman. Relative to the permanency of the tax cuts and the fact that these were only for 10 years, the 2001 and 2003 cuts, I was here at that time, and I think a little reflection on what actually happened might be in order. In the then Republican-controlled House, we wanted to make these tax cuts permanent. That was our goal. Unfortunately, it doesn't become law unless it passes the other body. And over in the Senate, they didn't have 60 votes to make them permanent. In fact, our colleagues on the other side of the aisle didn't want to cut taxes at all. And so there was a compromise, and the compromise was, well, we'll make it for 10 years. And what we were hoping is that we'd ultimately get the votes and be able to make these permanent. Same thing with the death tax. I mean, the fact that the Federal Government can take up to 55% of what a person has paid taxes on throughout their life when they die is just abhorrent as far as I'm concerned. And the same compromise happened there, where it scaled down year after year after year, and then went back up if we couldn't get our act together up here in Congress. So, but that was why the tax cuts weren't permanent. And I'd just like to have a response relative to how much better would it be if the tax cuts were permanent for your businesses, and if you think so, for the overall economy. And I'd be happy to hear from anybody who would like to comment.
I think any time that a business owner can have permanency of ideas and guidelines, it makes their business prosper, or at least try to prosper. And it's very difficult if you have to keep changing your method of operation every few years or every whatever. I mean, we need to have some sort of normalcy going forward. We have enough things that are hitting us from every other possible place in the universe. I mean, if we could have at least some guidelines in the tax law or in the estate tax, we'd know where to go from here to retirement, hopefully, sure, which is going to be a lot longer now than it was 5 years ago.
Right. Mr. Harmon, would you like to comment?
Yes, permanency would be a wonderful thing in the tax code. I mean, there's, the R&D credit, there's the bonus depreciation. Some of these provisions that are out there, it would have a significant impact on what you do year after year. And again, in manufacturing, we face global competition, and we've got to continue to invest in the equipment, the technology that's out there, training for our workforce, and the new research and development that our country participates and our industry participates in.
Thank you. Mr. Hodge?
Nothing undermines economic growth more than uncertainty, and there's, as you know, there's been at least 5,000 changes to the tax code in the last 10 years. And I think the economic benefits of these tax provisions, such as expensing, such as the lower rates, have been undermined by the uncertainty, by their temporary nature. And so Tax Foundation has always stood by the principle of certainty in the tax system, that there shouldn't be wild changes because it really does undermine the economic impact of them. And I think the more that we can set aside these arbitrary budget rules and scoring rules and start thinking about sound policy and the longevity of these things, the more we're going to see the economic benefits. But it's really because we adhere to these really arbitrary and sometimes really silly budget rules, we undermine sound tax policy, and the economy is the big loser.
Thank you. Mr. Porter, I've only got 1 minute left, so I wanted to get to one final question, and I'd be happy to, if anybody wants to respond here. You all, as small business folks, how would you respond to this allegation that's been made far too frequently this, I guess it's because it's a campaign year, political year more than others, but this allegation that business folks and yourselves included in that area relative to taxes, you just don't want to pay your fair share of taxes. You're these one percenters that are trying to take advantage of the rest of our citizenry. Any response to that? I assume you've probably heard this before. I see you nodding in affirmation. Ms. Kern, would you like to comment?
Well, as I mentioned before, I'm not opposed to paying my fair share and have been paying my fair share of taxes for the past 31 years. It's when the tax structure is out of whack that it kind of I think upsets people. But I don't think that's a fair statement to make about small business. We, as Mr. Harmon has mentioned, we provide health care, we provide 401ks, or we try to do everything that we can for our employees. I don't have 250 employees. I have 30 to 40 employees. And again, they're mostly union signatory except for the office people. So I mean, their health and welfare is $14 an hour. Their benefits are $35 an hour on top of their pay scale. So we do pay a lot of things to keep our people employed, and that's the cost of doing business. But I really take offense to the fact that we're trying to scam anybody and not pay what we have to pay. If I make money, I'm more than happy to pay taxes and have in the past.
Mr. Harmon?
Yeah, no, I think that that's an offensive statement. I think that small businesses and small manufacturers.
Just to be clear now, it's not my point of view.
Yeah, no. Yeah, I understand. I understand. Right. But the idea that we want to scam the system or not pay our fair share. We want to pay our fair share. We want permanency and stability in the tax code. And again, I mean, we're small businesses, small manufacturers. And I certainly know. I read the paper and see what some of the multinational companies pay, and I can tell you, we had a tough year last year, and we paid a lot more taxes than GE did.
Here are the actual facts. About 50% of all American households pay no income taxes, and many of those people get refundable tax credits, even though they owe no income taxes. And there's about $100 billion a year in refundable tax credits coming out of the IRS. Actually, more in refundable credits than what's available in the tax code, in the corporate code for tax expenditures. But the top 1% of tax filers pays a greater share of the income tax burden than the bottom 90% combined.
Could you repeat that?
Yes. The top 1% of tax filers pays a greater share of the income tax burden than the bottom 90% combined. So that top 1%, which is comprised of about 1.4 million tax filers, pays close to 40% of the income taxes today. And that's a greater share of the burden than is paid collectively by everyone earning under about $120,000 a year combined. Those are the facts from the IRS.
Thank you. Mr. Porter?
We certainly hope as a profession we're out there helping everybody pay their fair share of taxes and do it properly and report it in the way it should be reported.
Very diplomatic answer.
Thank you.
Thank you. I yield back, Mr.
Thank you. Thank you. Congresswoman Chu.
Well, I certainly was impressed with your stories, Mr. Harmon and Ms. Kern. Mr. Harmon, the success of your die castings business, being a second-generation family-owned business, and Ms. Kern, as a woman-owned business of a steel erectors company, that's really impressive. And I noted with interest, Ms. Kern, that you wanted to partake of SBA's 504 loan program, which provides approved small businesses with long-term fixed-rate financing for expansion or modernization, and also, Mr. Harmon, that you want to continue your contracts with the defense industry, because that's, of course, critical to your company. But I do have great concerns because if we extend all the Bush tax cuts, it will increase our debt by $3.3 trillion over the next 10 years. And in order to rein in our excessive spending, the government would be forced to make cuts to critical programs such as the small business loan program, such as the 504 loan program, as well as in the defense industry. And that's why I am concerned about extending those Bush-era tax cuts, and that is why I support President Obama's tax plan, because we have to have an overall view of our budget here in Washington, D.C. And Mr. Hodge, you gave a passionate argument about not hurting small businesses who are the entrepreneurs in this country, and I certainly agree with that. I just want to make sure that the small businesses are truly the ones that are the beneficiaries of our policy. And I want to ask you about what is really a small business and whether the pass-throughs are really all small businesses. And in fact, I have a suspicion that some of the pass-throughs are not necessarily small business owners. They include law firms, doctor offices, hedge funds, and lobbying firms whose businesses are structured as partnerships for tax purposes. They also include passive investors, such as those in real estate partnerships. Passive investors don't participate in any of the risky business decisions, yet receive all the benefits of the pass-throughs. In addition, many S corporations that are defined as a pass-through entity are not small. In 2009, only 0.3% of S corporations had incomes exceeding $50 million, yet they accounted for 35% of all S corporation incomes. Isn't it overreaching to say that these are all struggling small business owners, and should these very high income earners should be in a different tax category, and how can we make sure that the truly small business owners get the help that they need?
Well, we tend to think of these things in monolithic terms, and while the definition, the official definition of a small business may be firms under 500, according to the SBA, small businesses hopefully become larger businesses, become successful businesses. And raising taxes on these businesses as they try to go through the stages of business life is counterproductive to them becoming successful. We all want these businesses, whether they start out as a couple of college graduates with tremendous computer skills, becoming the next Bill Gates or Stephen Jobs or Steve Wozniak. They have to get there from here to there, and increasing their taxes as they go along the way, and simply drawing some arbitrary line in the sand saying, oh, well, then at this point they become a big business, I think is simply arbitrary, and there's no economic rationale for this. There's no economic rationale to say that of only 500 businesses is a small business. And the real problem here is that we have all of these different business forms. It does treat some businesses differently, and we need to maybe make sense out of it. The real point here is that higher taxes on these businesses is counterproductive. It does have economic impacts no matter how you define what that business is.
Well, let me ask this. Of course, in the past 4 years, the administration had the Small Business Jobs Act. It helped relieve small business tax burdens. It permanently allowed qualified small businesses to carry back their general business credits to offset 5 years of taxes. It put in place the elimination of all capital gains taxes for those who invest in small business and extended the 50% bonus depreciation. You made quite an argument for saying these are just temporary, and as temporary provisions that they are counterproductive. Are you saying that we shouldn't have had these at all?
Well, number one, in order to take advantage of all of those, you need to have positive profits. You need to be able to have income for which to deduct or make some of those deductions from. So for a lot of those businesses, bonus depreciation wasn't helpful because they simply did not have enough income to take advantage of that. I would prefer to, rather than seeing these sort of targeted, in a way like pork barrel tax policy, see broader reform where we lower tax rates across the board for all individuals, all businesses, rather than try these sort of shotgun approaches to specific constituencies.
So you wouldn't have had any of these provisions?
I would have lowered rates across the board rather than try these sort of shotgun, as I say, targeted approach.
Okay. Thank you. I yield back.
Thank you. Congresswoman Clark.
Thank you very much, Mr. Chairman, and I want to also add my voice to both Mr. Harmon and Ms. Kern, the success of your businesses and the growth and development of them. The fact that you are operating a second-generation company, Mr. Harmon, begs to ask the question, and Ms. Kern, having been in business for over 30 years now, that you've had the experience of operating your businesses pre-2001 at pre-2001 levels, prior to the Bush tax cut era, Bush tax cuts going into effect. And so my question is, it seems to me that prior to the Bush tax cuts, your companies were successful. What the Bush tax cuts have enabled you to do, I'm assuming, is to bring more capital into your companies. And so when we talk about the extension of the Bush tax cuts, I'm wondering whether the uncertainty is one of companies that may have started or have been in a growth period during the Bush tax cut era versus those companies that had been in existence prior to that. And wanted to know, what do you think is the best course of action given that we haven't done or addressed comprehensive tax reform, and, which is worse, the uncertainty of reauthorizing Bush tax cuts, or the stability of knowing one way or another where you stand in terms of your companies and a comprehensive tax code that meets the needs of your companies?
Yeah, that's it's a good question. Our business has been around for 93 years, and again, these tax cuts took effect in 2001, 2003, the Bush era tax cuts, and at that time, around that time, if I'm not mistaken, I think we were in a recession. We were in a recession that was occurring, and I think that might have been some of the stimulus for some of these tax cuts. But the other thing in manufacturing, in our business, we started really facing global competition back in the 80s. Japan came on board with their manufacturing, so American manufacturers had to really gear up for that. China came into play in the mid-90s, Mexico for a little bit in the early 90s, but we didn't have this type of global competition. Before 1995, it wasn't a huge global type economy and competition that we have today. I mean, since China's come on board, I mean, it's been just extremely difficult. I mean, we've got to be investing in these technologies, in new equipment, faster equipment, to compete with the Chinese products that come over to America. So that's why these cuts that are in place help. I mean, it'd be nice to get them permanent, but the bonus depreciation and the research and development that we can utilize and help make us more competitive in the world market.
And would you say that applies to your type of company as well?
It does, but in a different way. I'm primarily a labor-intensive company.
Right.
But I'm also subject to the Fortune 500 companies that want to build a plant or want to relocate. You know, that impacts my work. We've had a really, really tough 4 years over the past 4 years have been awful. But, the other thing is the heavy and highway. We try to supplement our work with road work. But again, that hasn't been, the transportation bill hasn't been funded, and that's another issue. But yes, it does. I mean, I was in business prior to the tax cuts, but that was a different economy. You know, we had more work then. So I really, I shudder to think of what we would have been like since 2001 if those tax cuts weren't in place, because maybe a lot of us wouldn't be here today.
The tax cuts in and of itself is not the end-all to be-all, because on the one hand, we're looking at the overall national budget. And as you've stated, if we don't have funding in transportation bills, which are a significant part of what helps make your company robust, then there's still a shortfall. So it's truly a balancing act, just from what I've heard from you both. And I think that we need to give a greater degree of scrutiny beyond the expiration or the fiscal tax cliff, as to where the balance is, because right now we're not striking that balance in our rhetoric. We're not being as balanced as we should be in really looking at the nuts and bolts of the companies that fall within the small business arena. And you two are examples of that. However, there may be companies that don't face the same type of global competition as a Mr. Harmon's company. And there may be other companies that are much more reliant on a domestic-based clientele. And so we really have to take a look at that, because I'm not convinced that these tax cuts are the end all to be all. And that's some of what I hear the debate being framed as. And I don't think that that's a healthy way of looking at a 21st century economy and how we support our entrepreneurs and small business, because there's so many other variables that are bearing on it. Did anyone else want to add anything there? Mr. Hodge, you look like you have a light bulb going off.
Well, Mr. Harmon's comments, I think, were very illuminating, because he is dealing in the global economy. And as I mentioned, not only the U.S. has now the highest corporate tax rate in the world at 35%, but the 35% individual rate that affects S corporations is also the highest business tax rate in the world by definition. So he is now competing against a global economy with much, much lower tax rates. Actually, 75 countries have cut their corporate tax rates in the last 5 years to be more competitive and to attract business, jobs, and investment away from high-tax countries like the United States. So it's incredibly important that not only we cut our corporate rates so that we can be more competitive, but cut our individual rates so that these types of businesses can also be competitive globally. And it's the businesses, the expansion of Mr. Harmon's company that can help Ms. Kern's company, because she would be doing the metal work on his factory. So that domestic investment is benefited by someone who can compete globally.
Clearly, and Mr. Chairman, I'm wrapping up. I just wanted to say that when we look at the domestic budget, that helps to really provide a catalyst for their companies, notwithstanding the tax cuts. If we're cutting defense contracts, if we're cutting and unable to put out a robust transportation bill, then notwithstanding that, the competitiveness still is undercut by our inability to strike that balance. So I just wanted to make sure that we sort of give a much more comprehensive look at what we're facing here, and do our very best to bear that in mind as we go forward. And I thank you, Mr. Chairman. Thank you very much for your testimony here today.
Thank you. Quick 10-second answer from each Ms. Kern and Mr. Harmon. directly, how would letting all these tax rates expire at the end of the year impact your ability to hire more employees? Mr. Harmon, quickly.
Significant influence and impact by having the taxes expire. I mean, we'd have to go back kind of in a constriction mode, I mean, a survival mode.
Ms. Kern, quickly.
We're surviving on margin thin, just razor thin margins right now that are very difficult to maintain. And if they undo these tax codes, then it's definitely not going to help us survive.
Thank you. I want to thank everybody for your testimony. You've all provided important insight into how actions and inactions in Washington affect what you all do out in the real economy. And I wish you, Congressman Schrader, and the whole committee wish you success in your current and future endeavors. I ask unanimous consent that members have 5 legislative days to submit any additional comments and material for the record. Without objection, so ordered. The hearing is now adjourned. Thanks.